On Monday, the 17th of August, 2026, the Philadelphia Semiconductor Index closed at 12,621. On Tuesday, it closed at 11,992, just under 5% gone in a single session. On Wednesday, it fell another 2.12%. And on that same Wednesday, the Nasdaq Composite, the index most people mean when they say technology stocks, closed higher. Both of those numbers come from the same place. Nasdaq's own index service marked data as of the 19th of August 2026, one Nasdaq index down 2%, another Nasdaq index up, same day. By Wednesday morning, there were three explanations circulating. It was the bond market, it was Iran and the oil price, it was the artificial intelligence trade coming undone. Those three cannot all be right, and two of them are wrong not as a matter of taste, but because the primary data contradicts them. The clearest evidence for that comes from a market almost nobody was watching. Singapore, where an index holding 0.81% technology opened down a full percent in sympathy with a sell-off it had almost no exposure to, and then bought the whole thing back before the close. Two housekeeping notes before I start. Every figure carries the date it was true because a market number without a timestamp is worthless. And none of this is financial advice. I am not telling you what to buy, sell, or hold. I am telling you what happened and which of the stories about it survive contact with the source data. Chapter 1: What actually happened. Let me lay the tape out and let me be precise about where every number comes from, because on this subject headlines round and they recycle yesterday's figure as today's. Tuesday, the 18th of August, 2026, closing levels. The Nasdaq Composite finished at 26,289.71, down from 26,644.91 the day before, minus 1.33%. The Nasdaq 100, the 100 largest non-financial companies on the exchange, finished at 29,490.96, minus 1.68%. The S&P 500 finished at 7,691.76, minus 0.69%. And the Philadelphia Semiconductor Index, America's semiconductor benchmark and the purest expression of the AI hardware trade listed anywhere, finished at 11,992.46, minus 4.98%. The first three come from the Federal Reserve Bank of St. Louis' daily series, which takes them from Nasdaq, and from S&P, the fourth comes from Nasdaq's own historical index data. None of them come from a headline. Now look at the shape of that: 0.7, 1.3, 1.75. That is not a market falling. That is one industry falling and dragging its index weightings behind it. Now Wednesday the 19th. Nasdaq Composite 26,331.09, up 0.16%. Semiconductor Index 11,738.23, down 2.12%. Over the two sessions together, from Monday's close to Wednesday's, the Semiconductor Index lost 6.99%. The Nasdaq Composite lost 1.18%. Same market, same 2 days, roughly 6 times the damage in one place. Hold that gradient in your head. Every explanation that follows has to account for it. Chapter 2: It was the bond market. This was the dominant explanation, and you can see why. On Monday, the 17th of August, 2026, the 30-year Treasury constant maturity yield closed at 5.31%. I checked how unusual that is, and it is genuinely remarkable. The Federal Reserve's H15 series runs back to February 1977. 12,372 daily observations. Since the 1st of January 2007, there are exactly 2 days on which that yield closed at or above 5.31%. One is the 12th of June 2007. The other is Monday, the 17th of August 2026. So yes, a 19-year high in the long bond. And the mechanism is real. A higher long rate lowers the present value of profits that arrive far in the future, and nothing on earth is a longer duration asset than a semiconductor company priced on the assumption that the build-out runs for another decade. Here is the problem. The sell-off was Tuesday, and on Tuesday the 30-year yield closed at 5.28%. It went down. The 10-year went from 4.72 to 4.71, down 1 basis point. The 2-year was unchanged at 4.19. So on the day that long-duration technology stocks fell 5%, the entire Treasury curve was flat to slightly lower. Let me be fair to the argument, because there is a version of it that survives. The H15 series records a snapshot taken in the middle of the afternoon in New York. Intraday, the 30-year may well have traded above Monday's close before settling back. At least one market write-up, published that day, quoted 5.32%, and that is entirely consistent with an intraday print the official close does not capture. But close to close, the daily record of the United States Treasury market says yields fell on the day of the rout. And on Monday, the day the yield actually made its 19-year high, the semiconductor index rose 1.64%. If your explanation for why an asset fell is that its discount rate rose, and the discount rate did not rise on the day it fell, you do not have an explanation. You have a coincidence you noticed on Monday and applied on Tuesday. Chapter 3. It was Iran and oil. The second story was geopolitical, reporting that week said talks between the United States and Iran had stalled. Crude was climbing, and a higher oil price feeds inflation, which feeds yields, which feeds back into the first story. The oil move is real and it is not trivial. West Texas Intermediate spot, as recorded by the Energy Information Administration, $83.99 on Friday the 14th of August, $86.04 on Monday the 17th, $86.48 on Tuesday the 18th. Note what that actually is though. Most of the move happened on Monday, up 2.44%. On Tuesday, the day of the sell-off, oil rose 0.51%. A 44-cent move in a barrel of crude did not take 5% out of the semiconductor complex. And there is a deeper problem with the geopolitical story, which is that it makes the wrong prediction about breadth. A genuine war scare is a risk-off event. Investors sell risk broadly and buy treasuries. That is the entire shape of it. What happened instead is that treasuries did not rally meaningfully. The 10-year moved a single basis point, and the following day the Nasdaq Composite closed higher while the chip index fell another 2.12%. There is no version of an Iran scare that produces that. Fear does not sort itself by industry. It does not spare the broad index and then take another 2% out of the semiconductor names on day 2 after the headlines have already been absorbed. I want to be careful here because I am not claiming oil and Iran were irrelevant. Rising energy costs were, on the Federal Reserve staff's own reading, part of why American inflation was running above target in the summer of 2026. I will come to that document shortly. Oil was a real macro input. It was just not what happened on Tuesday afternoon. The timing is wrong, the magnitude is wrong, and the pattern of who got hurt is wrong. 2 explanations down, which leaves the one nobody found especially exciting because it was neither a rate story nor a war story. It was a story about a single trade. Chapter 4. It was the AI trade. Here is the third explanation, and it is the only one that fits the tape I have just laid out. What fell on the 18th and 19th of August was not the market. It was the artificial intelligence hardware complex specifically. Everything else moved a little because that complex is now a large fraction of the American market's capitalization, not because anything happened to everything else. The evidence is the gradient. Minus 4.98% for the chip index on Tuesday, minus 1.68 for the Nasdaq 100, minus 1.33 for the Nasdaq Composite, minus 0.69 for the S&P 500. That latter is close to what you would predict from semiconductor weighting alone. The more chips an index holds, the more it fell. And then Wednesday settles it. If Tuesday had been a macro shock, rates, war, growth, anything that moves the price of money or the price of risk, Wednesday would have brought either a broad continuation or a broad bounce. Instead, the market split in half. Nasdaq's broad index went up 0.16%. Nasdaq's semiconductor index went down 2.12%. A macro shock cannot do that. A macro shock is, by definition, common to everything. When the discount rate moves, it moves for every future cash flow in the economy at once. What can do that is a change in what people believe about one industry's earnings. And this had been building for weeks, not hours. Look at where the semiconductor index actually was. On the 3rd of August, it closed at 11,430.35. By the 17th, it had climbed to 12,621, a rally of 10.4% in 2 weeks. Then it gave most of it back in 2 days, closing the 19th at 11,738.23. Sit with that for a second. After the two worst sessions of the month, the chip index was still above where it had closed on the 3rd of August, the first trading day of the month. That is not a market discovering a new risk. That is a market arguing with itself about the same risk, loudly, in both directions, and doing it in one industry while everything else gets on with its day. Chapter 5: The Fed Said It First. Now here is the part I find genuinely striking, and it is a matter of public record that almost nobody connected to the sell-off, because it landed right in the middle of it. On Wednesday, the 19th of August, 2026, the same day the chip index fell another 2%, the Federal Reserve published the minutes of its policy meeting of the 28th and 29th of July. Those minutes describe, in the committee's own words, the exact pattern I have been describing, written 3 weeks earlier. Quote, "Since the start of the year, equity prices for the artificial intelligence-related infrastructure sector had outperformed those for both the S&P 500 and hyperscaler firms, though appreciation of even those firms had stalled over the intermeeting period." End quote. And then this, which is the sentence that does the real work. Quote, "Equity indexes in South Korea and Taiwan dropped notably, driven by concerns about semiconductor company valuations. Equity indexes elsewhere were little changed overall." End quote. Read that again. Korea and Taiwan, the two most semiconductor-concentrated equity markets on the planet, dropped notably. Everywhere else was little changed. That is July. That is the same geographic signature that turned up in Singapore on the 19th of August, and the Federal Reserve's own staff had already written it down as a sector story rather than a macro story. The minutes go further. The staff judged that asset valuation pressures were elevated. Quote, "The equity premium, the forward earnings-to-price ratio adjusted for the level of long-term interest rates, was at a level that has only been lower in recent history during the dot-com bubble." End quote. On how it is being paid for. Quote, "A few participants highlighted the increased degree to which capital spending in the AI sector was being financed by borrowing, including credit provided by non-bank investors or regional banks." End quote. And on the risk itself, quote, "Several participants discussed as a downside risk the possibility that AI developments could disappoint, leading to a significant repricing of stocks with consequent negative effects on consumer spending." End quote. One more thing from that document because it bears on the bond story. The committee held the federal funds target range at 3.5% to 3.75%. 9 members voted for it, 3 voted against, and all 3 wanted rates higher, not lower. That is a tightening debate in the summer of 2026, which makes the level of the long bond a good deal less mysterious and a good deal less useful as an explanation for one particular Tuesday. Chapter 6: 0.81%. Now Singapore. On Wednesday, the 19th of August, 2026, the Straits Times Index closed at 5,694.24, down 7.16 points, minus 0.13%. The session range ran from 5,643.17 at the low to 5,694.24 at the high. Those figures are from MT Newswires, filed at 5:41 in the afternoon Singapore time on the 19th. Do the arithmetic on that range. The previous close was 5,701.40. At its low, the Straits Times Index was down 1.02%. It closed down 0.13% at the very top of the day's range. Singapore opened down a full percent because Wall Street had fallen overnight, and then spent the session taking all of it back. And here is the detail that turns a curiosity into evidence. Go back one session. On Tuesday, the 18th of August, the Straits Times Index fell 1.16% to 5,701.40. That was the worst of Singapore's 3 sessions that week, and it followed a Monday session in New York in which the semiconductor index rose 1.64%. Then the American chip complex fell 5%, and Singapore fell 0.13%. Over those 2 days, the relationship is not merely weak, it is inverted. Singapore's bad day followed Wall Street's good day for chips. Singapore's flat day followed the rout. The Wire copy said Singapore shares were tracking a sharp overnight sell-off in technology shares on Wall Street. I want to be precise about why that framing is close to mechanically impossible. FTSE Russell calculates the Straits Times Index and publishes its fact sheet. The edition dated the 31st of July, 2026, gives the sector breakdown for all 30 constituents. Technology, 1 constituent. Weight, 0.81%, 4.2 billion Singapore dollars inside an index of 522 billion. Banks, 3 constituents. Weight, 56.69%. DBS alone is 28.69% of the index. Overseas Chinese banking is 17.99. United Overseas Bank is 10.01. Add Singtel and the Singapore Exchange and you are past 2/3 of the index before reaching anything anyone would call technology. Real estate is another 13.71%. The whole thing yields 4.33%. So when a wire says Singapore tracked a technology sell-off, what it really means is that Singapore opened lower because Asia trades after New York closes and the futures were red. Within an hour or two, actual Singaporean buyers and sellers looked at what they actually own: 3 banks, a pile of real estate investment trusts, a telco, an airline, and priced it accordingly. That is not correlation breaking down. That is a market briefly borrowing somebody else's problem and then handing it back. Chapter 7: Why Singapore is Winning. Which raises the bigger question, because this was not a one-day event. From that same FTSE Russell fact sheet, dated the 31st of July 2026, Straits Times Index total return for the year to date in Singapore dollars, 24.1%, over 12 months 40.9%, over 3 years 93.9%. In calendar 2025 it returned 28.6%. Over roughly the same stretch, the 31st of December 2025 to the 31st of July 2026, the Nasdaq Composite rose 9.17% and the S&P 500 9.41%. Those two are price indices rather than total return, so the comparison flatters Singapore somewhat. It does not flatter it by 15 percentage points. So why 3 explanations get offered? The data can sort them. Explanation 1, it is the currency. A weakening dollar makes foreign returns look good. This fails cleanly. The Federal Reserve's own daily rate, $1 bought 1.2859 Singapore dollars on the 31st of December 2025 and 1.2783 on the 14th of August 2026. The Singapore dollar strengthened by 0.59%, half a percentage point. That is a rounding error on a 24% return. Explanation 2, it is the government. In February 2025, the Monetary Authority of Singapore launched an equity market development program. On the 12th of February 2026, MAS announced it was expanding that program from 5 billion Singapore dollars to 6.5 billion, and said it had allocated 3.95 billion across 9 appointed asset managers to date. That is real money and real policy, but look at what it predicts. The program exists to deepen the market and anchor capital for Singapore-listed companies broadly. If state-directed flows were the engine, you would expect the wider market to lead or at least keep pace. It did not. The Straits Times Index returned 24.1% for the year to date. The broader FTSE ST All-Share returned 22.1%. The 30 biggest names beat the 102. I will be honest about how much weight that carries. The All-Share is only about 12% larger than the Straits Times Index by market capitalization, so it is not a clean read on small companies. It is suggestive, not decisive. Explanation 3, it is the banks. 57% of the index, so it had better be. And here the primary source says something most people get backwards. From DBS's own results release of the 6th of August 2026. Second quarter net profit 3.08 billion Singapore dollars, a record, up 9% on the year. But net interest income fell 2%. Net interest margin dropped 18 basis points to 1.87%. The rate trade is over. What replaced it is in the same release. Net fee income up 25%, wealth management fees up 42% to a record 919 million. Wealth assets under management 516 billion Singapore dollars. Singapore's banks are no longer being paid mainly for the level of interest rates. They are being paid for holding and moving other people's money. Chapter 8, what would change my mind? Let me now attack my own argument, because a thesis you cannot break is not a thesis. The first weakness is the sample, 2 trading sessions. Tuesday the 18th and Wednesday the 19th of August 2026. Markets manufacture spurious patterns over 2 days constantly, and had I picked a different pair I might be telling you a different story. What makes this pair informative is not the size of the move but its shape. The clean monotonic ladder from the S&P's 0.69% down to the chip index's 4.98, and then the sign flip on Wednesday with one Nasdaq index up and another down 2%. Still, 2 days. The second weakness is that one of my central numbers is a close, not a continuous record. The Federal Reserve's 30-year yield is a snapshot taken in the middle of the New York afternoon. If someone produces an intraday tape showing the long bond spiking hard into the equity sell-off and retracing before the snapshot, the bond explanation recovers a good deal of its credibility. I could not find that tape. I also could not rule it out, and I have tried to say so plainly rather than quietly. The third is sourcing. The Singapore Exchange does not publish its own index history in any public form I could retrieve, so my Singapore closing levels come from 3 commercial sources that happen to agree to the second decimal place, a wire report timestamped to the 19th, and 2 market data providers. 3 sources agreeing is reassuring. It is still not an authoritative exchange record, and I would rather have one. The composition weights, by contrast, come straight from FTSE Russell, which actually calculates the index. Those I am confident in. So here is what would falsify this. If over the coming weeks, the semiconductor index recovers and the Straits Times index rises with it in lockstep, then the 19th of August was noise, and Singapore's insulation was luck rather than composition. If the next Straits Times factsheet shows technology weight climbing meaningfully above 0.81%, the mechanism weakens, because the index would then have something to lose. And if Singapore's bank earnings turn out to have been a rates story after all, if net interest margin re-expands and fee income stalls, then Chapter 7 is wrong about what is actually being bought. None of this is financial advice, and I want to end by being explicit about that. I have not told you that anything is cheap or expensive. I have not given you a target, and you should be suspicious of anyone who does. What I have tried to do is show you which of 3 competing explanations survives its own evidence. And the most useful market on the 18th and 19th of August was not the loudest one. It was the quiet one, 9,500 miles away, that had almost nothing to lose and therefore told you exactly what was being lost.